The results season has officially shifted gears, and we are moving out of the tech sector and into the colossal landscape of banking, financial services, and insurance.
That's right. The focus is squarely on finance right now. I mean, we're seeing reports rolling in already, and then the weekend. That's when we get the heavyweights, ICICI Bank, HDFC Bank.
Exactly. And that's our mission today. We are diving into a really comprehensive research report that focuses on financial services. And this isn't about small tweaks to price targets.
No, not at all. The headline here is massive, almost, unprecedented re-rating.
The scale of it is just shocking.
It is. When you see a firm take a massive established player like SBI and move its price target from $720 all the way up to $1150.
Wow.
Or HDFC Life jumping 200 points. That's not just quarterly noise. That signals a deep fundamental shift in how analysts are viewing the sector's stability.
So why such a dramatic increase in optimism all of a sudden? We need to unpack what the market was missing until now. Let's start with maybe the most surprising part. The margin upside in insurance. I mean, you see names like HDFC Life and SBI Life getting these huge upgrades. I think most people assume insurance profits come from, massive investment pools. What's actually driving this?
It's not the investments, it's the product mix. It really comes down to one thing: the protection business. We've seen really strong growth in protection numbers. So plain vanilla term insurance, pure risk products over the last few months.
Wait, I always thought the big money makers were the investment-linked products, the ULIFs. You're saying that's not where the real margin is?
That is the crucial aha moment. ULIP margins they're thin, maybe around 10%.
Okay.
By contrast, the protection business is hugely margin accretive. You're talking about margins around 80 to 90%.
80 to 90, that's a staggering difference. So that's almost 4 times the company's average margin.
Exactly. So even a small shift in your sales mix towards more protection products has this huge outsized impact on profitability.
So that volume growth is translating directly into margin upside.
It is. Now, we should say, the next 6 months might be a little tricky. There's an issue with the input tax credit, which could create a temporary drag.
But looking past that, maybe to FY27, what makes this a long-term story?
Well, if this protection growth continues, which the analysis suggests it can, you're looking at significant sticky margin growth. But it's also about regulation. You've got 2 potential structural reforms coming down the line.
Okay.
A move toward risk-based solvency measures and the implementation of IFRS, the International Financial Reporting Standards.
And for anyone who doesn't track accounting standards, why is IFRS such a big deal here?
It just forces a much higher degree of transparency and uniformity in how companies report their financial health, especially risk. So you combine that kind of structural stability with a business mix that's delivering 80% margins. And suddenly those higher price targets start to make a lot of sense.
Right. Okay, let's move on from insurance to the NBFCs. The report makes this fascinating kind of counterintuitive argument here. It basically says you should look away from the biggest names.
Yeah, it's all about the trade-off between growth and profitability once you get to a certain size.
The cost of being too large.
Exactly. The physics of lending just change. It becomes incredibly difficult to sustain those aggressive, high growth rates that the market expects without sacrificing your profitability. You just run out of good borrowers to lend to at the right price.
Can you give us an example with a major player?
Sure, take the Josh Finance. It's the poster child for growth, right? In its non-mortgage book, it generates a phenomenal return on assets, or ROA, something like 5.5 to 6%.
Which is incredible.
It is, but the market expects them to keep doing that while growing their AUM past 10 lakh crore. And look, their growth targets have already been revised down from 30% to about 22%. It's just not sustainable to maintain that high in ROA and push for that kind of scale. You have to compromise on one or the other.
So the market is starting to bet that a compromise is inevitable, and that opens up the opportunity in the smaller and mid-sized NBFCs.
That's where you find the valuation arbitrage. These smaller companies, they often trade at half the valuation of the big guys, or even less. But because their base is smaller, they can still deliver similar growth potential, and they can do it while keeping their ROA stable. There isn't that constant pressure to compromise just to hit a bigger number.
It's about finding that sweet spot then.
Exactly. The report highlights names like AB Capital and Shriram Finance as examples of companies that are kind of threading that needle good growth potential, stable profitability, and a much more attractive valuation.
Okay, this is where we get to the core of the re-rating, I think, the public sector banks. The upgrade for SBI was just massive. For years, the market has been, let's be honest, deeply skeptical of PSUs. What has fundamentally changed?
This is a tectonic shift. And it's driven by two factors, one of which is, well, it's a total anomaly. First, on the simple side, PSUs are quietly gaining loan market share. They're growing faster than some of their private peers.
And they don't have the same funding crush. You're talking about the loan-to-deposit ratio, the LDR.
Yes, exactly, the LDR. Private banks are struggling with high LDRs, meaning they have to scramble for expensive funding to grow their loan books. PSUs, because of their massive deposit base, just don't have that problem.
Okay, so that's balance sheet stability. But the historic nightmare for PSUs was always asset quality.
Yeah.
Huge corporate loans going bad. Has that cycle finally been broken?
That is the single most crucial driver, the benign asset quality. PSUs have this huge 70 to 80% exposure to corporate credit. And right now, that credit quality is squeaky clean.
Squeaky clean. You're saying the huge wave of corporate defaults from past cycles?
Yeah.
It's just not happening.
Not happening at all. And here's the shocking part, the real anomaly. The slippage numbers, the defaults for some of these big PSU banks are currently lower than the credit cost numbers of some high-performing private banks.
Wow. Okay, but corporate credit is cyclical, right? Why is this time different?
Well, the thinking is it's coming from systemic reforms and deleveraging that's happened over the last few years. And when you have this low credit cost environment, it completely changes the valuation logic for PSUs.
How so?
A PSU bank might run at a return on assets, or ROA, of about 1.1%. That sounds low compared to a private bank.
Right, compared to a 2 or 3%.
But they use leverage very differently. They run at high leverage, maybe 14 times. So that 1.1% ROA translates directly into a 14% return on equity, or ROE.
And that's totally comparable to a private sector bank.
Entirely comparable. And here is the kicker. You get that same return profile, but you can buy the stock at a much lower price to book, often at 1 times book or even below.
So you're getting private bank returns at a public sector price. That changes everything.
It does. It means high leverage, when you combine it with almost zero corporate credit risk, is suddenly a huge positive. The recommendation is pretty clear. Stick to the bigger, more established PSU names where this is most visible.
All right, let's shift back to the private sector titans. Despite their reputation, the outlook here seems to have some near-term jitters, especially for HDFC Bank. What's the challenge there?
With HDFC Bank, the long-term earnings growth story looks solid, all the way through FY28. But the market right now is fixated on one thing, deposit growth. It's been subpar recently.
And because of that, their LDRs went up, which you mentioned earlier. What does that mean for them practically?
It means they're stretching their stable funding base to meet loan demand. They have to rely on more expensive wholesale funding, and that can really start to squeeze their margins. For HDFC Bank to really outperform, they simply have to get the deposit growth equation right.
And what about the other big names, ICICI and Kotak? They've been market darlings for ages.
For them, the concern is more about the earnings trajectory peaking. The forecasts suggest their earnings growth will top out around FY27, and FY28 might even be a little lower.
A deceleration.
A deceleration, exactly. And that creates uncertainty. Plus, with ICICI specifically, you have this question mark around the CEO's tenure, which adds another layer of, well, near-term jitters for investors.
So if the biggest, most expensive names are facing these issues, where does the report suggest looking in the private sector?
The argument is for a tactical shift toward banks with cheaper valuations that are basically playing a catch-up game.
Right.
The prime example cited is Axis Bank. It's a higher beta stock for sure, but its earnings growth for FY27 is projected at 30% plus. It's coming off a weaker base, so you're basically buying into a clear, near-term earnings acceleration story at a more reasonable valuation.
Okay, let's shift gears completely to the new generation. The fintechs, like Paytm and PB Fintech, they've seen upgrades too, but a lot of traditional investors are still pretty skeptical. What's driving the optimism here?
The driver is all about profitability, specifically a move toward positive EBITDA. But the key phrase here is unadjusted EBITDA.
Okay, break that down for us. Why is the word unadjusted so crucial?
Because for years, many of these growth companies would report adjusted EBITDA, where they'd exclude very real costs, like most famously, employee stock options, or ESOPs.
Right, which is a real cost.
It's a very real cost of doing business and attracting talent. The market is now rewarding the companies that are proving they can be profitable without those kinds of adjustments. It's a search for proof that the underlying operating model actually works.
And is that proof emerging?
It is. Paytm specifically has done a good job of showing real operating leverage. Their revenues are finally growing faster than their costs. Now, there is a valuation ceiling. These companies tend to trade around a 50 times FY28 EBITDA multiple.
So the current upgrades get them to that level, giving them a neutral rating for
Yeah.
now. To get more upside, what do they need to do?
They need to surprise on the upside. They have to deliver much better EBITDA numbers than what's currently baked in. The market is waiting to see if they can justify an even higher multiple with truly exponential profit growth.
Okay, last segment. Let's touch on the mid-cap private banks. Names like Federal, RBL, City Union. There's a lot of market hope for turnarounds here, often when new management comes in. Why is this report so skeptical?
The core issue is just structural rigidity. It's a common mistake to think a new CEO can come in and just flip a switch. Many of these older private banks have deeply ingrained issues. It could be outdated IT, a regional focus they can't break out of, legacy
So
problems.
turnarounds aren't easy?
They are incredibly difficult and take years, so the preference isn't for the hope of a turnaround, but for models that are already proven and time-tested.
Like what?
Well, the example used is City Union Bank. It has a 90% secured asset base, it sticks to its core domain in southern India, and it can consistently, reliably deliver a 1.5% ROA.
And the analysis favors that guaranteed number over the hope of something better.
Yes. The smart money, according to this report, prefers the reliable delivery of that 1.5%, rather than buying a struggling bank on the hope that it might one day achieve that same number. Reliability has a premium right now.
Okay, let's try and synthesize all of this. It feels like a clear rotation of preference across the whole BFSI space. We saw the surprising power of protection margins in insurance, the huge valuation appeal of large PSUs driven almost entirely by that pristine corporate credit quality, and then this strategic rotation within private banks toward cheaper, high-beta names.
And if you connect all those dots, the big lesson is how the definition of success seems to be shifting. It's less about raw scale at any cost growth, like we saw with the challenges for big NBFCs.
Right.
Instead, it's about stability through benign credit quality, which is transforming the PSUs or demonstrating true operating leverage that translates into hard, unadjusted EBITDA for the fintechs. Consistency and verifiable quality are finally being rewarded over pure growth.
Which leaves a pretty fundamental question for anyone investing right now, doesn't it? In a market that has always loved high growth, is consistency and stability, like that 1.5% ROA from a City Union Bank, or the high ROE from a cheap PSU, now valued higher than aggressive but maybe unsustainable expansion? What metrics will truly define the next cycle's winners? That's something for you to mull over as we head into the thick of earnings season.